Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I'm going to be your host for about the next 25 minutes here on Options Guide TV. Actually, it might be 20 minutes. We do have a trade that we can review. It was in IWM, and the trade is kind of played out. Talked about the fact that I looked at a long straddle in the IWM. As one alternative to this trade, but we did a ratio back spread, and with the leanings towards the bear side of the Russell 2000 and the small caps, based off of the fact that they had a quick run up. Market did come down a little bit, but it's came back up, and now it's actually leaning towards the bull side of things. So we'll look at that trade, but we have a lot of mega cap tech stocks that are going to be announcing earnings. We're going to be kicking it off tomorrow with Tesla and Google, two of the actual Meg 7 stocks that will be announcing. And, otherwise known as Alphabet, I should say. Google, otherwise known as Alphabet. So we're going to look at an Alphabet trade today. We're going to do something a little bit different. We're going to stick in the butterfly theme, but we're going to be much more bullish than a lot of the other butterflies that I've done around earnings. Very interesting trade, and I think I want to set that one up first, and then we'll go back, and if we have time, we'll review the IWM trade that we did about 10 days ago at this point in time. So if you have any questions and you are in the Tradier Hub, make a profile. So log in via the Tradier Hub profile, and you can ask questions inside the hub. If you go to the YouTube channel and you have logged into your Alphabet profile, then you can also ask questions. And lastly, we stream live through x.com. And in that platform, you can't ask any questions, but feel free to join along. So here we go. Right now, we have Google. Let's go to the Tradier Pro software. And we have Alphabet trading at 181.04. Right now, the market is up. Earnings tomorrow, so I'd probably set this trade up closer to the close tomorrow, but I'd use the same type of conditions that I'm going to introduce to you. We're going to go the July 26th expiration, and one of the things, and I've talked about this a lot, that the way that I'm going to approach the strategy has a much different leaning because they're announcing on a Tuesday and the option contracts don't expire until the Friday. If, like Amazon, who almost always announces on a Thursday, then all you have is 1 day of trading. Thursday after the close, they announce, and then you have 1 day for those option contracts to live. So that makes butterflies a little bit more interesting, just a standard butterfly, because you need time decay to be you need time to go away real fast on a 1 day butterfly. And if you have the earnings report after Thursday, obviously you just have 1 day's worth of trading. And if you're correct on your forecast, you get paid a lot quicker on a 1 day butterfly. So I'm going to do a more bullish trade that will let the marketplace play out. So let's start by looking at Google and just looking at the most at the money straddle. If we were to buy, this is the July 26th expiration. This side of the options grid inside the Tradier Pro is the call side, and this is the put side. Market's at 181.40. The most at the money option contract would be the 182.50. If we buy this and we buy this, let's call it $11. You look at a little more than 11. You look at around $11 on a $181 stock. You're talking about an expected move right around 6%. So the marketplace is saying the over-under on Google going until the Friday 26th expiration. So realize that this is saying the expected move by that date. And a lot of people kind of gloss over that fact and say after earnings, they're looking for it looks like 6.2% move in Google. Okay, so I just want to be within that range. Now, a one standard deviation move is going to be somewhere right around the 16 delta. And the Tradier Pro software actually highlights that. So I have selected inside the option chains to have the grid highlight where a 1 standard deviation move is at. And that's right around here, right between the 195 and the 197 strike. Now, the 1 standard deviation move is further out than the expected move. There's only a 16% chance of the stock finishing at least 1 cent percent higher on that expiration date. So it's a different number, and realize that the standard deviation isn't the expected move. The expected move is usually less than a 1 standard deviation move, and it's what the marketplace is willing to pay in order to buy a long straddle based off of the news and everything that's going on. So there is a little bit of difference now. So I want to be within within that expected move. So the market right now, we're at 182.50. If we add 11 to that, that would be 193.50. So right in this range, right by this strike. So I'm going to buy the 190 strike. Now I'm going to lean bullish, and when I get to the what if calculator, it will become clear that I'm okay if the market takes off on this trade. We're then going to go 7.5 points. The wider, the better, but we're going to go 7.5 points. We're going to buy the 197.50 strike. And a normal butterfly means that you would go another 750 and you would end up buying the 205. Now, note here, by buying the 205, if we just look at bid to bid, real tight markets because of the earnings and everything, that's only a dime more to buy that. But it changes the dynamic of the trade a lot on the trade. So you pay a dime more, but now on the upside, if the stock blows through the 205 mark, which can happen after earnings, if that does happen, then you have your net debit paid, you have at risk. So if we do this trade, we got and I'm going to point to it down below at the bottom of the screen. We're doing the July 26th expiration this Friday, 4 days away. We're going to buy the 190, sell 2 of the 197.50s, and buy 1 of the 202.50s. Now, this would just be a non-standard butterfly. I don't really have a good name for it, honestly. I've never really heard this strategy be named. Some people would say a Christmas tree, but a Christmas tree is really a 1 by 3 by 2, where the ratio is different. Here, we're just not going to buy. We're not going to go out 1 extra strike price and pay. We're going to pay 12 cents more for our option contract is really what we're doing for our protective hedge. So it's a little bit more expensive, but it's still $1. It's trading for 107. When I looked at it initially, it was 104. So let's put the midpoint on. This will be our official paper trade, 108. So for every 1 by 2 by 1 ratio that we put on, we're going to pay $1.08 or $108 plus any fees to get in and out of the trade eventually. Now, I'm going to send this to the what if calculator, and we'll see everything that I'm talking about. Okay, so by not buying that strike, and look over here, because this is where where your profit and loss is. If you don't buy that strike and the market goes on up, you have the potential, if it just blows through the numbers and goes all the way up to here, to make 140 on that trade. Right now, you're going to make about 149. That's where the green line is. But all that is going to come in and implied volatility and everything. So right now, this is your profit and loss graph. This is where your last trade was at. But eventually, it's going to morph into this. So your real risk is mainly to the downside, or if it doesn't at least make the expected move on the upside. So if earnings are good and the market doesn't move 6%, the market only moves 3% and gets to around 186 or so, well, that's one of your risks. The market goes down, that's another risk. But if the earnings report is perceived as good and we make at least the expected move, we get to the 190. We have a potential for a home run somewhere right around our middle strike, which is 197.50. And if it continues on up, just who cares, right? It goes all the way on up. We can still at least make 140 on our trade, which I would consider that a very good trade. Now, the maximum we can make is 750. And if you get the maximum, you should also get the stupid award, because that means that you hung around all the way to the very end and you got darn lucky that it just went out right at your strike price. I say that because if you're anywhere around that strike price and the expiration is approaching, you should just get out of the trade and try to make $500 or $600 as opposed to $140. You shouldn't just take the chance that it's going to go out right at that strike price, right? So this is our scenario, and this is what the way that we're looking at this trade. And it has, as opposed to a skip strike butterfly where you're doing it for a net credit and the market goes down, we're going to have upfront risk. We're going to pay $1 for it. And I like to look at this trade and compare it to, well, what option contract could I buy for $1? I'm paying $1. Now it's $1.03. So let's call it $1. Let's put it right at $1. Paper trading this right now. Now, remember, I would do this tomorrow. I'd put it on tomorrow, same type of scenario. I want to be within the expected move after earnings, and see where the market ends up, because it's up strong today already, up 1.85%. Now, if I'm taking it as of today, like they'd be announcing after the close today, and I pay $1 for this trade, what can I pay $1 for, right? Look at this. The 195 strike is that $1. That's the one that I could buy for a little bit more. We call it about $1.12. So I could either buy one of those or I could do this butterfly. Now, here's the downside. You're looking at 195. We're not talking about the expected move now. You're talking about a 1 standard deviation move. You're right on the precipice. It's 16 delta right here. 1 standard deviation. It's got to move further, a lot further, 5 points more than the 190 strike to get in the money on this trade. Also, no help with implied volatility, right? We're going to be selling 2 option contracts that are going to decay. If we're correct on our forecast with the butterfly, we want implied volatility to come in. We want time decay to happen. Our best case scenario is at expiration if the stock is right at 197.50. In this scenario, we needed to get to 195 quickly, and we are going to get crushed by implied volatility because we're just long an option contract. What's the upside of buying this as opposed to doing the butterfly? Well, if the market went to 240, right? Well, we'd knock it out of the park. That would 100% be a home run. You wouldn't receive the stupid award for that by any means. So you limit your upside, but you get a lot of benefits on the butterfly going into it. So if you're not looking for a home run or a home run trader, you could spend $1 and buy the 195 and have all those other risks that I talked about, or we could go into the butterfly and have limited and known upside above 202.50, potential to make more somewhere between 190 and 202.50, somewhere in that range. And we got $1 worth of risk. So if the market goes down, we got the same amount of risk as if we bought this, but a much different dynamic. And I honestly like the butterfly better than just buying the call outright. I'm okay with hitting doubles and singles as opposed to trying to get home runs after an earnings report. That's simple. If you have any questions, go ahead and toss them in that chat box right now about this trade. If not, we're going to make this official paper trade. So let's go in and say, we'll do 105, I guess. The market's still moving. We are buying the January 26th expiration 190 strike call. At the same time, selling to, the July 26th of the July 26th 197 strike call. And then we're going to buy that same expiration 202.50 strike call. We're going to do this for a net debit of $1.05 to the account, $105 plus commission for every unit that we put on. Or another way to say that is every 1x2x1 butterfly that we trade. All right. Now, since we do have some time, let's go look at IWM. And let's just go look at the chart. Okay. Well, we'll put that in there. IWM right now, still up 0.5% today, so it's still doing strong. And IWM has actually been outperforming the NASDAQ and the S&P 500 index. It's been very volatile within this space right here. But the last week was actually the worst week for the S&P 500 index and the NASDAQ since April. So a bad week last week, and it looks like we're getting the buy the dip situation. And of course, we got all the political news that is happening. So you can determine what is driving it more so. What's driving the move upwards, if it was the overbought or oversold conditions, or is it the political landscape? So in this scenario here, we went out a few days ago and we did a ratio back spread that said that if the market ran down when we got up, we had 1, 2, 3, 4 days that said if the market tanked on us, that we would have substantial upside potential. And we also said that if the market went up, we'd have limited and known downside. So the market meandered on its way down. We wanted it to be below the 220 level, and we're a little bit below. So at this point in time, we're probably just going to want to close out the trade. It would probably be done for a minimal loss at this point in time. The market does run up, we get a small gain, but we're not getting the move to the downside, and half of the time has gone away. So I just would unload that trade and look to get out of the trade. I also talked about on that day a long straddle in the IWM, and that actually, since the market had the big run up and also has a decent run down, the market's actually moving enough in order to pay off on the long straddle. So the long straddle was the better trade, is really what the moral to the story is. And IWM is still just real interesting how it hangs around in this area. And they're saying that there could be, well, the pundits are implying that maybe this is a flight to small caps, away from, so you're supposed to sell your Nvidia and your mega cap tech stocks going into earnings and buy some Russell 2000. So I don't know if that's the case. That's just what I have heard. All right. So that's it for this edition of Options Guy TV. If you are in the Tradier YouTube channel, please ring the bell and give us a thumbs up inside there so you get all the alerts for the next edition of Options Guy TV. And we'll be back this Wednesday at 11 a.m. Eastern time to see how our Google trade played out and come up with another strategy on someone else that's going to be announcing earnings going into the end of the week. Thanks for stopping, and we'll see you on Wednesday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.